Hello everyone, welcome to Team 120, first segment of Financial Freedom for Middle America. My name is David Tristan. I am the owner of Family First Insurance and Financial Services.
I'm Louis, Martorelli Financial Services.
We are Team 120.
So David, why are we here today?
Lou, we're here to offer clarity to Middle America about retirement and financial fitness. As you know, wealthy people often pay someone to manage their money. But what about our clients? Who's helping them?
Well, Team 120 is. So hopefully in this video and over the course of the next several weeks, we can help people get a better understanding of how to secure their financial future, which is so important, David, because as you know, most people aren't saving enough.
You're right. Actually, I just read an article that claims that the average American household has $225,000 in debt. And many of them only have $500 in their savings.
Wow, $225,000. Well, that sounds about right. You know, what are we talking about? Like a mortgage and 2 car payments?
Yeah, pretty much.
Well, if that's the case, I sure hope they have something saved for retirement, because, you know, they're estimating that we're going to need, the average person is going to need about $750,000 in retirement. And that's the median income of about $50,000 a year. If you earn more than that, you could need more than $1 million in retirement.
Wow, that sounds like a lot of money, Lou.
It does sound like a lot of money, but really, David, if you think about it, what are some of the factors that are inhibiting our ability to outlive our money?
Well, the first thing is, we're living longer.
Right.
Did you know that they're predicting by 2050 there will be 8 million people in their 90s?
Yeah, I saw that. That's a lot.
8 million people in their 90s. Now, if you take that into consideration with inflation, our medical expenses alone in retirement is going to cost us $250,000.
Right, that could take a big chunk out of your retirement.
Absolutely. Now, let's not forget, didn't we just have a big tax overhaul?
Right.
So taxes right now are at an all-time low, right, with the new reform. So you're saying that in retirement, I could be paying more money in taxes.
Right. People aren't expecting that, are they?
No, they're not.
Right. So here's the thing. When most people hear these things, David, they think to themselves, I'm never going to be able to retire. But we don't want them to panic. We want them to know that they can get on track. Because, David, how do you eat an elephant?
I don't know, Luke.
One bite at a time.
Well, I would hope so. It's an elephant. So it's like taking baby steps. If I start now and I just follow my yellow brick road, I'll be able to get there. What's one important thing to remember about securing my financial future?
Everybody says the same thing. Pay yourself first.
Okay, so let's say, for example, my employer tells me, hey, business is slow and I got to cut back on your salary. So instead of getting my average paycheck, I'm going to lose $200 a week.
Right.
So my check went from $3,000 to $2,800. What do you do?
Well, you learn to live on $2,800, don't you?
Well, that's right. And what you need to do is have your future self cut your salary and pay yourself first and learn to live on the rest. And the sooner you start, the better, because, Lou, as you know, time is more valuable than money.
That's a good point. And it sounds like a good plan, but where do we invest the money? How do we maximize results?
Well, this is how we do this. When it comes to retirement savings, your options fall into 3 categories, what we call 3 tax buckets.
Okay, I've heard of that. So what we're talking about there is the taxable bucket, the tax-deferred bucket, and the tax-free bucket.
That's correct. So let's talk about the taxable bucket.
Okay.
The taxable bucket is like what everybody has: your checking, your savings, your money markets, your CDs. But you don't want to have too much money in there. Okay. Usually you want to have 3 to 6 months worth of savings in there.
Why is that?
Well, because interest rates are at all-time low, you're actually hurting yourself by putting the money in there.
Right.
Okay, because it's not doing anything.
It's taxed. It's not earning much. It's not even keeping up with inflation.
That's correct. So you're going backwards. Another one is stocks and bonds. So everybody knows what stocks do, right? But there's one big disadvantage to it, and that's that it's volatile. It's at risk in the market.
Right.
The same thing with bonds. You know, these are factors that we have no control of. And then the last one is mutual funds. So mutual funds is just, it's a pool of money that a company uses to help mitigate your loss, but it's still investment in securities.
Right. And there's fees involved in mutual funds.
Yes, we didn't even get into the fees. But the biggest advantage about this bucket is that you have liquidity for it.
Okay.
So you can access it as soon as you can. But let's talk about the second bucket, the tax deferred bucket.
Right. So the tax deferred bucket is the one that most people are familiar with when it comes to retirement savings. And what are we talking about in the tax deferred bucket? Your 401k, your 403c, your 403b, SEPs, simple IRAs, traditional IRA, annuities, and real estate. Okay. All of these investments have two things in common. The first is contributions are tax deductible. Okay, so if you earn $100,000 a year, you put $10,000 into your IRA or your 401k, you're only being taxed on $90,000 a year.
Okay, helps your tax liability.
That's right. The second thing is that distributions are treated as ordinary income. So this is the most important thing to understand about a tax deferred plan. Okay, so when you go to take that money out in the future, you're going to be taxed at whatever rate the current income tax rate is. Okay. Do we know what our income tax rate is going to be when we retire?
I was just going to say, how do I know what my tax rate is going to be in the future?
We don't. And that's the thing. You know, it's very difficult to predict how long your money in your tax deferred investments is going to last, because we don't know how at what rate it's going to be taxed. I can almost guarantee this. Tax rates are probably going to be higher than they are now, right? They're at an all-time low right now, and we know that the government has unfunded liabilities in the amount of about $46.7 trillion over the next 75 years in just Medicaid, Medicare, and Social Security alone. So, David, where are they going to get the money to pay for those things?
Well, I mean, they got to raise taxes.
Yeah. So, the next tax bucket is the one that has the most interest for me, and that's the tax-free bucket.
Absolutely. So this tax bucket doesn't have as much products as the first two.
Okay.
This one actually has not so many. The first one being the Roth IRA.
All right, so how is the Roth IRA different than the IRA we talked about in the tax-deferred bucket?
So the IRA is your money's taxed. Okay, it's pre-taxed. And then it goes in.
You pay for it with after-tax dollars.
That's correct. Yeah. So after you've been taxed on it, you put money into it, and you let it grow. And then when you put on it, it's tax-free.
Well, that sounds great. Can I put as much money as I want in it?
Well, if it was that easy, everybody would have one of these. Okay. The fact of the matter is, you have to qualify for this, and you're only limited on how much money you can put in there.
Okay.
Okay. And it differs between people. So it's got its ups and its,
And what about municipal bonds? How are they different than the bonds in the taxed?
So municipal bonds is another tax-free bucket, but it's not a true tax-free bucket, because a municipal bond, depending on the state that it's in, you still may be required to pay state taxes. But also on the downside, the growth is not that great.
Right, so it doesn't sound like something that you can really build a lot of wealth with, a lot of income with.
That's correct. You're not really growing your money as fast. Now, the last one is, Lou, have you ever heard of life insurance that you can retire on?
Absolutely. Most people have never heard of using life insurance as a means to generate income in retirement. But we're going to get into it, aren't we, David?
Absolutely. We'll be covering some very valuable information in the second segment of our series next week. So from here going forward, every Tuesday, stay tuned to Team 120's page. Like us on Facebook, okay?
We're all about offering value, so don't hesitate to contact us if you have any questions.
That's correct. So please like our Facebook page, Team 120 and Associates.
Subscribe to our YouTube channel, Team 120 spelled out.
Like this video, share it, leave comments or questions in our comment section.
I'm Louis.
And I'm David. We are Team 120.
Agencies ensuring peace of mind.
Thank you, guys.